Okay, hi everyone. My name is Richard Perry. I'm market analyst, and I'm working with INFINOX and providing webinars and content and videos and everything that hopefully that you're receiving for your analysis content is our production. And yeah, we're going to do another monthly webinar for you. And before I kick off, I'm just going to quickly show you the very short disclaimer, but it is going to be a webinar where we're going to be talking about live market information. So it is just that, it is just information and not to be constituted as investment advice for you. This is, yeah, I mean, but we're going to do a webinar where we do the usual agenda, where we look at the big picture macro driving factors behind what's happening through markets, and then we're going to pick into different asset classes. We're going to look at Forex, we're going to look at commodities, and we're going to look at indices as well. And at the end, if anyone's got any questions about your trading, just drop it into the Q&A box, and I will do my best to answer your questions at the end. But yeah, it's a Q&A that we'll be having at the end. So if you're sort of wanting to interrupt halfway through, we're not going to be able to do that. We're going to do it towards the end. Okay, so kicking into it, looking generally at markets, always we have interesting months when all the central banks are reporting, and this is the coming month in June is, I think, going to be another interesting one where we do have all of the 8 major central banks giving monetary policy updates this month. And for that reason, certainly the one on the top, the Federal Reserve, is going to be front and center, because the June meeting of the Federal Reserve is a meeting where we get the economic updates of the projections of forecasts, and also we get the dot plots as well, which is always really important for where the Federal Reserve Committee see monetary policy moving. Now, the sort of expectation is, I think, towards the back end of this year, we're going to see the Federal Reserve moving towards stopping its asset purchases, and how the Federal Reserve now starts to guide for that move, because it's likely to come in probably the December meeting, where they actually say, right, we're going to start cutting back on asset purchases. They will not do that straight away like that. They will guide in the meetings coming up to that, or meeting, more than likely it'll be probably 2 meetings, maybe 1, but maybe 2. Before that event, they will start to guide markets for that. So we're now in the process of looking for the sort of language changes from the Federal Reserve that could give a hint as to when that might be. And we may start to see that in June. It's still not likely, but there may start to be some little hints in the Federal Reserve meeting in the coming month that might start to hint at tapering asset purchases further down the line. Now, how markets have been reacting to really quite significantly rising inflation expectations and inflation indicators has been one of the key themes in the last month. And this growing inflation risk that we have is a really important factor. Now, you can see here, this is the chart of US inflation, and it started to rocket higher, certainly on the headline CPI and core CPI basis. And we're likely to see also the core PCE, which is the core personal consumption expenditure, which is the Federal Reserve's measure of inflation. That's also likely to start to accelerate higher. And if, well, I say if that happens, as that is happening, that is having quite a significant impact on markets, basically because of the expectation of inflation and the expectation of growth are the 2 key factors that drive bond markets, and bond markets drive foreign exchange markets. So how the US Treasury bond markets move will have a really significant impact on how the dollar moves. And that is a really key factor in the fact that, if I show you here, and here. And we can see here, this is a measure of inflation. Inflation is currently in the US on a 10-year basis, looking at around about 2.5%, but the bond yield is only 1.65%. So effectively, you've got a negative 0.9, as you can see down the bottom here, 0.9 negative on the real yield basis. So in terms of interest rates, they are actually negative by 0.9. So that's not positive for the dollar. And when that line moves down, it means that the dollar comes under pressure. And you can see that, sorry, not that one. Find it now. This one here. You can see that line falling to minus 0.9, coming with the dollar falling as well. So these two are very strongly correlated. So falling negative interest rates and negative for the dollar. So dollar-related pairs are the dollar is getting hit from all sides at the moment, and you can see that how the dollar has moved in recent weeks as that negative real yield has started to fall back again. The dollar index has come under pressure to the downside, and we've seen that really impacting through markets. So that falling dollar is a really a big function of those increasing inflation risks, and that is a key factor that is driving markets still at the moment. So any indicators that come out from the US, such as inflation, such as retail sales, anything that suggests that inflation is building in the United States is having a negative impact on the dollar, and that is why we're seeing the dollar falling. So does the Federal Reserve react to that is the question, and does the Federal Reserve start to use less dovish language and start to guide towards the end of this hugely loose monetary policy that we have through the major central banks? And European central banks, similar sort of issues. We can see that bond yields in the Eurozone are moving strongly higher suddenly. And that now means that the European Central Bank has some questions to answer, I think, on June the 10th. How does the European Central Bank deal with the fact that bond yields in the Eurozone are now suddenly moving quite strongly higher? You can see here, all of these bond yields are now moving strongly higher, as not only, there are two aspects to this, again, inflation and growth expectations. Now, the growth expectations are also improving in the Eurozone because the vaccine levels are starting to really now pick up. And I've got actually a chart here. Zoom in a bit, and you can see here, these Eurozone lines here, Ireland, France, Italy, Germany, are all accelerating higher. Now, it's interesting that the front runners in this, the UK, that line slightly tailed off. The US, again, another front runner, has slightly started to tail off. So this is coming as the Eurozone numbers of vaccines are really going. So the market spent February, March, April, all sort of factoring in strong US, strong UK. Now, we're starting to see, I think, the Eurozone picking up in the vaccine front, and it's not surprising to see that we're now starting to see these Eurozone bond yields go higher, and also the euro is strengthening as well. So that's a positive for European markets, so these bond yields going higher. But how does the European Central Bank react to that? Because they are, again, ultra loose on monetary policy. How do they respond to that? Do they start to sort of tail back? They're now coming to the end of this this phase of front-loaded PEPP, which is Pandemic Emergency Purchases Program, the quantitative easing that it introduced. They're now coming to the end of that 1 quarter front loading that it has. So what do they do now? That's the question on the 10th of June. Across these other major central banks, I'll sort of just pick out the Bank of England, because again, the Bank of England is another central bank that's slightly starting to move towards removing these emergency pandemic measures, slight tapering in its last meeting. What does it do for the next meeting on the 24th of June? And other reserve central banks, Australia, New Zealand, we're not really expecting too much from those guys. Maybe from the Bank of Canada, though. Maybe from the Bank of Canada, again, possible taper there. But the key thing is all these central banks coming in June. As I said, other aspects is inflation risk. How are these inflation risks playing out through markets? Fiscal spending from both the Eurozone and the US. Joe Biden, he's already put through 1.9 trillion of fiscal support. He's looking for another $4.1 trillion worth of fiscal support to go through in various packages that he's trying to get through Congress. Now, how well does that get through? Because obviously that all needs to be paid for, and the question is, how does it get paid for, and does it get scaled back? Is that? And finally, the EU Recovery Fund, 750 billion measured against the US. It doesn't sound like a great deal of money now, but still 750 billion shouldn't be sniffed at. But it's still sitting in the courts at the moment. And can the courts now start to free up that money so it can be spent in the Eurozone? Again, that could be a positive for the Eurozone if that comes through in the coming month. Couple of aspects I've got here at the bottom. How does the Indian variant of COVID affect countries? I mean, at the moment, the UK is starting to sort of pick up in these, but does the vaccine rollout in the UK mean that it's not so much of an issue? If it picks up in the Eurozone and the EU, has the EU got enough vaccines to cope with that? Would be the question there. And finally, Israel-Palestinian tensions. It makes harrowing viewing actually on the television, all these bombs going off. But does that now spill over into the Middle East? It's a tail risk, but it's a possibility that other countries could get increasingly worked up about it, and that wouldn't be positive for risk appetite there. Okay, so as I said, drivers in June, all central banks updating. Will the Fed react to growing inflation? How does the ECB react to front-loading PPP? Bank of England tapering. Oh yeah, the other one on the Bank of England is this is the final meeting for there's only one member who's dissenting to the current policy of holding interest rates and quantitative easing levels, and that guy Andy Haldane he wants to cut back on asset purchases, but this is his last meeting. So how does he leave that post? And who also replaces him, and what are they going to be voting like? It would be an interesting point to find out this month. So yeah, so with regards to going back to bond yields again, just very briefly, I'll try not to focus on it too much, but you saw that that chart there. Actually, hold on, it was this one. Oh no, it's not. Let me just try to find it. That one there is rising inflation, but interest rates, i.e. treasury yields, are moving sideways. And that is the issue, actually. If treasury yields continue to move sideways, which got this chart here, it certainly looks as though that is pretty range bound. I don't think you're going to see the dollar performing at all. You might see occasional little rallies on the dollar, and you've got the dollar, which has just accelerated again away from this downtrend that it's been in throughout the last 6 weeks. You might see another technical rally, but you've got loads of resistance now overhead for these dollar moves, and a recovery in the dollar is unlikely to last. I think it's going to be hit by further selling pressure, and you can see here resistance 90.70 to 90.90 on dollar index. First big resistance coming in there. Yeah, I'd say any rebounds I'd be looking to sell that dollar, because I think anything you get as an opportunity would be just that. And I'll talk about some trading opportunities for Forex majors in a little bit, but it certainly looks as though that dollar index has got further to go to the downside. 89.20 up towards 89.70 certainly looks as though it's going to come under threat in the coming weeks, and more than likely, more than likely, I would say you're probably going to see the dollar coming back to 88.25, which is the 2018 low. So, and the reason is because I think that bond yields are moving sideways, so I think that the dollar struggles in that. So through June, I think, as ever, really, we're looking at the data, and what you've seen, interestingly enough, is certainly for US data, you've seen some wild surprises on the US data. Economists have massively missed where the expectations have been wildly wrong, and that is because, in my opinion, that's because of the April 2020 comparatives have been so wildly skewed to the downside that it makes it impossible to really accurately gauge how the real recovery is in that data. So subsequently, yeah, I think we're looking for more surprises. So expect the unexpected, I would say, in terms of the data. And I've just got here watching key correlations. Now, yeah, in markets, you do have, across asset classes, you do have some key correlations, and I'm going to show you. I've shown you a few. Treasury yields, yeah, the Treasury is interesting that as that inflation has spiked higher, Treasury yields in the US dollar have lost their correlation, and it's actually turned negative. So that's an interesting one. Maybe something to not watch there. But more interestingly, I think, is the gold correlations. This one here remains strongly negative. So when the dollar's falling, gold is rising. That is a very much of a traditional play on gold. When the dollar's falling, gold tends to be rising, and that certainly is and has been the case for months and months and months. Very strongly correlated negative. 0.8 negative is an extremely strong negative correlation between the dollar and gold. Gold and equities has sort of lost. It's been a bit choppy, and it's sort of gone neutral currently. This is an interesting one that I'm actually looking at for a report I'm writing. Is that the S&P 500 and the dollar have an average correlation of 0.37 negative since the beginning of 2020. So it would suggest that when the dollar's falling, US stocks are still positive, and that would tend to be how markets usually move. So that's a little bit supportive still, you would argue, still for equities there, and I'll go through my outlook for equities in a bit, but certainly that would suggest that equities are still going to be fairly positive coming further down the line as that dollar continues to fall. Okay, so looking at the Forex outlook, what we have is as I said to you, I think the dollar will continue to struggle and continue to be underperforming and to sell off whilst the real yields are falling. And you can see this. I mean, I sort of show it on what's the one that shows it best? This one, not this one. Okay, is this one? Sorry. So yeah, when real yields are falling, which they have been throughout late March into April, you're going to see the dollar under pressure and falling away. And that would suggest anything that drives inflation higher is going to be negative for the dollar. So that's what we're looking for into June, is the dollar continuing to struggle because real yields are falling because of the inflationary pressures. So that's negative for dollar index. As I showed you earlier, dollar index back to test 89.20 to 90 big figure. And 9040 to 1990 is a sell zone now. Yes, I've put 1968 here, but 1940 was this reaction low that we saw actually. Crosshair is the reaction low that we saw there. So anything into this zone here, I think, is a sell zone for dollar index. Okay, looking at the other Forex majors, as I said to you, I think the euro is going to be positive in the coming weeks, and the reason, well, one of the main reasons, is these rising bond yields that we've got on the euro bond for Italy, Spain, Germany, all rising, and also yield spreads from the the peripheral bonds over the core bonds, which peripheral bonds are seen as Spain and Italy over the really secure bond, German bond. Yields rising, spreads are rising. That is a positive for the euro, and I think euro is going to perform well. And lo and behold, what we've seen today is euro breaking through resistance. Two other Forex majors as well that I like the look of are the Canadian dollar and sterling as well. I mean, Canadian dollar has been in an enormous downtrend channel. It's incredible actually, against the US dollar, and I don't really see that as changing. I'll show you the chart of that in a bit. With regards to the Aussie and the Kiwi, they have been more ranging and with a very slight positive bias within those ranges, but I prefer the sterling, Canadian, and euro at the moment. And also the Haven Forex as well, the Japanese yen, Swiss franc don't look great. They may well get occasional rebounds on risk appetite scares, might help to drive a little bit of near-term yen strength or near-term Swiss franc strength, but ultimately I don't think they look that positive. So we've got a few trades here. They're all dollar based, they're all major pairs, so let's have a look. Right, starting off with euro dollar, breaking through this resistance. Actually, let's open that out to there. Breaking through the resistance that we've seen coming in around 2180. That was a key move, and if it can close above that, that is a really key move, because what we saw back in February was the initial break above resistance and then a decisive intraday pulled back and actually a shooting star candlestick. But at the moment, this candlestick looks really strong, and it looks as though the euro is gaining ground. So I think this is a really strong move. If euro can hold a break above 2180, this looks strong. And I think ultimately in June, although you might well get a bit of a pullback, and I would be watching out for the 21-day moving average on that, I think that as a basis of support, 2080 at the moment. I think that any pullbacks are a chance to buy euro dollar. I think it's going to be coming up to test this key resistance area 2350 in June. I think that would be somewhere that I'd be looking at for euro dollar to be testing. In terms of the technicals, it's all very strong. Momentum is consistently housed above the 50 mark on the relative strength index. That is always, I say always, that is certainly a positive, holding above that 50 line and moving up towards the 60s and towards 70. That's a positive, and it would suggest that any weakness should really be seen as a chance to buy on euro dollar. Looking at cable, again, arguably sort of similar, but even possibly even stronger, because you can see cable now is actually up towards or looking at the resistance that we saw at 142.40 of the February high. It's having a look at that, and it's looking strong. But if I come all the way out, you can see here this big uptrend channel, really positive. Look how number of times that sterling dollar has come back to use that uptrend, and that's basically in the course of the past year. This is a 12-month uptrend, and it looks as though it's on the brink of breaking out again. Once more, we're looking at strong momentum. Where could we go to if we break out above that? Well, just zoom in one level here. you can see that the reaction high that we got back from 2018 was 43.75. So that would be your next basis of resistance. But looking longer term and as this year goes on, and you can see the strength of this uptrend channel and the strength of the momentum, it certainly looks as though any weakness, I think, in cable is a chance to buy. I think 140 is a great level now. If you got a pullback to 140 that then held support within this uptrend channel, that would be a great opportunity for medium to longer term buying towards maybe even if you sort of continue that run higher and this uptrend channel for a breakout, possibly August time. But I mean, considering the fact that it's accelerated high, it's looking a little bit stretched. You could argue maybe that due a pullback, but I think anything in terms of a breakout back at sort of Q3 later this year, I think you could see breaking out into the mid 140s and beyond. You look at how this is the long-term chart of cable. It's got a lot to unwind, and certainly the Brexit related sell-off, which was 2016, that comes in around the 149, 150 mark. So I think anything back towards the mid 140s is perfectly possible. Brexit's out the way, UK economic recovery, dollar under pressure. There's no real reason why that can't continue to move higher. And as I said, moving to buy into the weakness. You've got a great support band now, 39.50 to 40 big figure within this to look for opportunities. Dollar yen, you do have this this uptrend that's been in place throughout this year. It's a pretty good uptrend actually. It's now coming back to test it though. So what you've seen, and I think what you may well continue to see now, is that the dollar yen sort of topped out back in March, and it's been very choppy since then. And if you look at the links between dollar yen and the US Treasury yields, you can see that they are pretty similar this year. Let's zoom in. They have been moving pretty similarly this year. This is the dollar yen and the spread between the 10-year US bond yield and the 10-year Japanese bond yield. And you can see very, very tight move between the two of them. So where bond yields move and where spreads move, that is a big indication for where dollar yen goes. And it looks as though Treasury yields are a little bit ranging. Certainly the Japanese bond yields are ranging. So what does that mean? The likelihood is that I think that dollar yen ranges. And that's one of the reasons why I'm not really a big fan of the yen at the moment. I think the dollar's under pressure. I don't really see that the yen is doing a great deal. So I think ultimately dollar yen could be a bit of a boring one at the moment, but it looks pretty ranging to me. Even though it's in this uptrend, I think that chances are that uptrend now starts to break down, and we probably just settle into the continued sideways move on dollar yen. Now, just as an aside to that, you just caught a glimpse of euro yen. Now, this is another really interesting one. This is one of the reasons why I like euro yen, again, because of the bond. Look how tight these yield spreads are. Again, this is the spread of the 10-year German bund over the JGB, which is the Japanese government bond yield. Where that spread moves has a big indication on where euro yen moves. So that would suggest with yen going sideways, euro is strong. So that's something that I really do like. Euro yen is just going gangbusters at the moment. It's around 133 big figure. It's just multi-year highs. And at the moment, I don't really see that trend changing. So I think if you were looking on MT4, just get euro yen. That's copper. daily. Zoom, zoom, zoom. Right, you can see here, look at that uptrend on euro yen. Any sort of unwind on that uptrend to come back towards a really cracking area of support actually. Now I'd say 132, 132.40, 130.160, good support band there. You wouldn't really want it to go below 131 figure, I would add, because that would then start to break that uptrend. But any pullback towards, I think, 132 area, 132 big figure, if you saw that and you saw the market starting to build support again, that would help to unwind that RSI, that relative strength index, which is a little bit stretched at 70. You'd rather pick it up around the 55-60 mark, but I think it does look a positive. And euro yen, you'd be trading that on the long side. So the thing with technicals is you trading with the trend gives you the most opportunity to profit. Because it's when you trade against the trend is when you start to get unstuck, I think. I mean, say, for example, if you were looking for contrarian indicators on euro yen and you think, okay, well, the RSI is at 70, I should sell that. My very sort of risk averse hat on, I would say that is a pretty risky play, because you're trading against the trend. You're trying to sell in an uptrend, and I think selling in an uptrend is a really, really high risk strategy. So you want to be buying into uptrends, so you'd be looking to either chase this one higher, which at the moment is looking a bit stretched on momentum, doesn't tend to go too much beyond 70 before a little mini corrective moves. I'd be looking to buy that on a pullback around about that 132 mark, but certainly at the moment it looks really strong on euro yen. US dollar, CAD, Aussie CAD, Kiwi. Oh, sorry, sterling. I haven't done sterling yet, or have I? Yes, I have. Sorry. Aussie dollar. Let's do Aussie dollar first. Again, one of the reasons why I'm not a big fan of Aussie or Kiwi at the moment is this, really. It's sideways. Since December, since January, really, it's gone sideways, pretty much nowhere. I think that is going to continue. You've got a slight positive bias within this sideways move. Momentum on the RSI just dipping towards the 50 mark and then moving up towards 60, 65. That sort of hints towards slight positive bias, but within a range. Yeah, I just think there are better opportunities out there. Aussie is struggling a little bit. You've got the announcement the other day from China about iron ore and trying to reduce speculation, and yeah, it doesn't help when China does things like that, because iron ore is a massive exporting commodity for Australia. So yeah, that leaves me a little bit worried about Australia dollar, sort of, and whether it can move decisively high. It doesn't seem to want to move decisively higher. There seems to be barriers overhead of resistance that come in around the 78 sort of 20 mark, 78 up towards 78.80. So yeah, I'm just a little bit wary of trading Aussie, because I think you often get these big pullbacks and it doesn't really seem to go too far. It's very much ranging, seemingly, on that chart. And let's just have a look at Kiwi. Similar sort of moves, really. Again, Kiwi has struggled for direction since throughout this year, really. It's gone sideways. I mean, it's been a bit sort of fluctuating. Again, hitting its head over the resistance around that 73 figure area, struggling. You might see a little sort of poke above that, but again, I wouldn't be looking for a breakout to be lasting too long. I think, again, similar look to the momentum on Kiwi is that sort of 45 up towards 60 area is on the RSI is a slight positive bias, but nothing decisive. But let's look at one that is decisive, and what a chart this is. Okay, let's just zoom out here, because basically what you do have, and I've got these trend lines wrong now, because on a strong long-term basis, you've got a really good downtrend channel actually on the dollar CAD, which you'd be looking to sell any strength you get, I think, on that. It's currently stretched to the downside. It looks oversold. It's below 30 on the RSI. It has a very strong momentum to it, this chart, but I would say that it is stretched, and you'd be looking to sell into strength. And I think I focused on this in one of the written reports that I did last week. I think it was that I was saying that it's stretched to the downside, could be due a rally. It did eventually pick up a little bit, but then sold almost instantly. So I'd just be I just think that at the moment you are looking a little bit stretched, but it could be due another technical rally, and that reaction that we've had off the floor today may be a hint of a rebound on a near-term basis. Let's have a look. 4-hour chart. Yeah, you'd probably, where would you need to get that through? Well, there's key resistance overhead around 120.80, 120.90 area. Need to get through that, and then above that moving average, which on the 4-hour chart, yeah, above 121.40 to really start to see that swinging higher. But yeah, I'm just I think on dollar CAD looks excellent in terms of selling into strength if you can get a selling opportunity that helps to unwind that oversold position. Yeah, I think that's actually Forex done. Right, commodities. Okay, you've seen some enormous rallies on commodities, just huge runs higher in copper, in iron ore, and lumber in the States. Incredible move, actually. And also, if you look at how these charts have gone, we've seen that it's all about the reflation story and the infrastructure spending coming back in, economies reopening, positive for commodities, huge rallies on these commodity prices. And it's interesting that we've started to see gold really pulling higher within this, and I think that is really interesting that we've now started to really see some upside move on gold. And I've dropped back here to July 2020, which was the all-time high, which was 2075. And there's a downtrend you can measure here. It only had 2 points of contact as a downtrend, so that reduces some of its real relevance. But you can see that this uptrend channel that we have been forming over the past few months is now broken even that downtrend. So that's a positive. You can see the consistent run of higher lows, higher highs within this uptrend channel, pulling back into support to find support around that trend channel. You've got the 21-day moving average, which is a really good basis of support now of that trend channel, pretty much right at the bottom of that. And you've got the basis of support around around 1820, 1820. And I think any pullback on gold, again, should be seen as a chance to buy. It does tend to be seen that you get these sort of 2 or 3 day rallies, and then it just sort of peters out a bit. And we saw that previously. We've seen 3 days of rally, and it's an interesting little consolidation here, and that's interestingly as well coming with the RSI around 70, which was RSI only got to 70 back in January, but that was the point at which you saw a corrective move. I'd be saying that any unwinding move back towards into support around the sort of mid 50s area, 60 on the RSI, I think would be an opportunity to really get into gold once more, because I think this is going higher. As I said to you earlier, that correlation that we've got on gold is really, really strong. That correlation of well, this is the other correlation: real yields falling, gold rising. And again, that is because gold is because if you see the fact that gold comes up against the dollar, where is it? That one. Again, similar move: dollar down, gold up. So those are all linked trades that are linked, and I think the gold is coming further higher in this recovery. And bearing in mind we're sort of hitting up against the resistance as well at 1875, you could see that near-term pullback, which may well unwind you back towards maybe the 1820 to 1830, 1840 area on gold. But again, into support, I would see that as a buying opportunity as that unwinds gold. And if you look on the and the fact that silver is also very much in the similar boat, really. Silver and gold tend to be fairly closely aligned, and not only have you got the characteristics that are helping gold higher, also help silver as a precious metal, but also the fact that you've got the industrial reopening and economies sort of kicking back into gear. Silver is seen as also a bit of a hybrid metal, really, between an industrial metal and a precious metal. Silver is used for both, and we can see that on MT5, silver again uptrend channel, looking strong. Uptrend channel, as I said, possibly a bit of a blowout today at resistance, interestingly enough. So you may well see a bit of a near-term pullback. But again, any pullback that finds support within this uptrend channel that helps to unwind that RSI, I think is a buying opportunity. Anything back towards sort of mid-50s on RSI within this uptrend channel that finds support around that sort of 27.10 mark, 27.30 area, I think that's an opportunity. Silver looks like it's starting to swing higher. And again, 21-day moving average is a good basis of support there. And finally on commodities, yeah, oil. It's been a bit of a slow burn, oil. And again, this uptrend channel is fairly shallow, and you look at the momentum of that move, it's above 50, but it's not all that strong. It sort of struggles around the 60 mark, so 50 to 60 is again a mild positive bias, and you can obviously see that within this uptrend channel. But the other thing I wanted to say was that these candles don't really tell me that the market is going to be bursting higher, and it's sort of hitting this resistance around 70 bucks, and again sort of pulling back a little bit. You might see it retesting the channel lows again. Yeah, I'm okay on oil at the moment. I think it's mildly positive. I'm not going wild. I don't think it's going to be bursting insanely higher. Technicals are not really sort of suggesting that, but I'd still be looking to buy that into weakness. It's just that I think it's not as aggressive as an uptrend channel as the channels that we see on gold and silver, which certainly look to be strong. And on indices, right? Okay, indices. Yeah, very interesting. Basically, for the last 5, 6 weeks, maybe, because I wrote an article actually for the May monthly report, and I was saying that I thought that indices are looking a little bit corrective. Potentially, they could start to come under a little bit of corrective pressure in May, and that would be seen as a buying opportunity for some of the strong stocks within those indices. I still see that could be happening, but if you look on some of these indices, and I'll show you the key ones that we look at, S&P, DAX, and FTSE, you can still see that these are all big uptrend channels. They look a little bit corrective near term, and I sort of wrote an article again that's on the website actually, as the S&P 500 came up in this rally, it was always falling over on momentum. That's called a negative divergence. That's a warning signal. And ultimately, what we did then see was 3 sharp days of selling pressure. It's interesting that we've seen a bit of a retracement of that selling pressure, but that retracement has started to stumble a little bit, which again leaves me a little bit uncertain, because we've seen that the moving averages sort of started to roll over. That resistance seems to be building around that 4180 mark on S&P 500. You've not really seen a great recovery on momentum either here. So this leaves me a little bit worried that the key support, I think, is still got to be 4100 on S&P 500. If you see that broken again for a second time, I think you could easily see the market back at that uptrend channel support. But ultimately, I think you'd still be looking to buy into weakness on these. The key question, I think, looking further out through the year, is how indices respond to the Federal Reserve tapering asset purchases. A taper tantrum is obviously going to be what it's going to be called if that is the case. If equity markets respond badly, and it does always seem as though that as soon as you get any sort of corrective pressure coming through, that someone will or central banks will start to give dovish hints again. It does seem a little bit perverse, doesn't it? But obviously what we see is the fact that equity markets continue to rally. So I don't think that equity markets or the S&P 500 is going to be falling sharply away. I'm still a little bit concerned for the near-term prospects that this rally has just started to sort of tail off a little bit, though. And you may well see that there is another little leg lower, but I still think uptrend channel is intact on that. DAX similar really, but again sideways for the last 5-6 weeks. Very choppy moves actually, but again, if you zoom back out, you'd be thinking, well, every time the DAX breaks out to the upside, it then finds support, builds support at a higher level, and then pushes on again. So essentially, this is just the next phase of that, where it's building this support consolidation range. You could argue that the uptrend is still intact, although that decisive intraday move to the downside would question whether that is true or not, but still looks as though that it's pretty strong. I mean, again, it tested all-time highs today. Actually, it has slightly broken all-time highs, 15,535. But again, just sort of stalling a little bit, and you've got this happening with the momentum looking fairly ranging as well, again between sort of 40 low 40s and low 60s. So again, you're not really showing too much decisive strength through that. I mean, maybe a closing breakout above the high would help to change that, but again, I'm a little bit, yeah, I'm just not sure. I think there's a lot of very volatile candles in this, a lot of strong candles, big solid bear candles and bull candles, which doesn't give you a great deal of confidence of trading in any one direction at the moment. I think for that reason, I'm a little bit cautious with sort of going too long on the DAX at the moment. FTSE 100, another uptrend channel that we've got, a little bit more sedate on the FTSE 100. But again, sort of pulling back actually, and the pullback came into support band, used as a chance to buy, rallied again. A little bit concerned, a little bit cautious about how the candlesticks of the last 2 sessions have gone, but you're still in an uptrend, so you'd be looking to buy into the weakness of that. And again, you actually look at the momentum; it's pretty positive on FTSE, between 50 and 70 on RSI is pretty good constitution to this uptrend channel. So you'd be looking to buy into the weakness. And I said on the written report that I wrote on Friday, I think it was, buying into that 21-day moving average. Look at that. Seems to be a really good basis of support. Although obviously it had its exceptions last week, but on a closing basis, it seems to be holding fairly well, that average. So that's something to watch out for. but it certainly looks as though it's still building within that average. Sorry, building within that uptrend. Right, everyone. Yeah, that sort of concludes what I was going to say. If you've got any questions, please put them in the question and answer box. At the moment, I can't see any at the moment, although maybe they're being held back. So you've got some time to write a question, and I will do my best to answer it. Any questions you've got regarding your instruments you're trading, any technical indicators you want help with, anything that you think I need to explain again a little bit more clearly, perhaps, anything that is interesting you. So yeah, just put it in the chat box and I can cover that. Just to let you know, we do have the potential to send out these slides if you would like them. So again, if you'd like to see the slides, then I think we can send them out for you. Are there no questions? Again, any strategies that you're looking at, questions about technical analysis, questions about fundamental analysis. Had a couple of good ones last time actually that we covered and got some good responses to that. So yeah, anything that's that you need help with or tidying up from the presentation, yeah, just ask. Here we go. Yes, no problem, sir. I will. I'm sure that the INFINOX guys will help you out with those slides. Okay, just a question on that euro yen trade that I was doing. Right. Okay. Okay. Buy on euro yen, is it also a short-term buy? Yeah, that's a good question, because on euro yen, as we showed you, it is really quite stretched, but it looks really strong. So if you're looking at this chart on a daily basis, I'd say it is looking strong, but again, it's had that another run higher, and it's looking stretched on that relative strength index there on the daily chart. And if I put the crosshair there, you can see that every time it gets to 70, it really does struggle, and especially when it starts to turn back from 70 would be that struggle point. I mean, okay, so in the last 1, 2, 3, 4, 5, 6, 7, last 7 of the last 9 sessions it's been up, and that's a pretty strong run higher. So you'd be looking for signs of exhaustion on that. And again, even on the 4-hour chart, you've started to see a little bit of a pullback. So that's starting to be a little bit of a concern for me. But you can see here on the 4-hour chart, that breakout that we saw a few days ago, the 14th, above that resistance, then got that old resistance became supportive for the next leg higher. So that would be the same issue we've got here. That breakout that we've seen in the last day or so, above 32.95. If you now start to see the market closing decisively below that, I'd sort of be looking at, okay, let's put it on the hour chart. If you start to see the market certainly below 132.75, but I think if you said 132.85, then I think that you'd be questioning how much more this run higher has got, and you could start to see a bit of a near-term corrective pullback. And just as I said, the last couple of hours, you've started to see signs of a little bit of a pullback. So I'd be just bearing in mind that it's had such a strong run higher on the last sort of leg higher. It is probably looking due a bit of a pullback at these sort of levels, and that's not to say that it can't continue to go higher. I would just be cautious in terms of using quite tight stop losses to prevent you from sort of losing that upside, because let's just draw in a little mini uptrend here. Again, that's a pretty decent indication, that uptrend there. Again, you can draw that uptrend. You've got the 21-hour, 4-hour, sorry, okay, on the 4-hour chart, the 21 period moving average, let's just call it that, which is this line here, is again a pretty decent gauge. And again, the fact that it comes basically around that uptrend, for me, would tell me that that's a good basis of support to use. So I'd be looking to use stop losses around that sort of area. The key breakdown, I think, on a near-term basis would be below that 32.50 mark. If you saw it below 32.50, which was the latest breakout and then was used as a good line of support, if you see it below that, I think it then is starting to turn corrective. But it is strong still, and just because something is stretched on momentum doesn't mean it can't continue to go higher, but you'd be looking for exhaustion signals and signs of sort of the market rolling over for that. Tolilope, I hope that answered your question for you there. A few questions about the slides, so that's good. I'm hoping that they've now been answered. I'm new to trading. Where should I start the knowledge of trading? Well, okay, so it's a good question, and I think it's probably something that the sales guys at INFINOX can certainly help you with. That they can help you out with there.
Yeah, we'll get someone to be in contact and give you a bit of an oversight on that.
But you might need to show your name. It says anonymous attendant.
Yeah, we may well have your email if you signed up with an email. So we'll send you an email.
Okay, any other questions?
Doesn't look like there's any more questions, Richard.
Okay.
So let's wrap. I think we can wrap that up now.
Excellent. Well, thank you very much for being part of our webinar again. I hope you enjoyed it. We're going to do again another one in June. It will be hopefully you'll be getting the invites and can all attend again, and sort of looking at potentially expanding what the service that we do with these webinars as well. So keep an eye out for that. But yeah, it'd be good to have you all on board again. And with that, I'll leave you with that disclaimer once more, and I'll speak to you again next time. Thank you.